Meta is growing revenue at 30% year over year, yet the stock price has dropped roughly 10% since January. That decline is happening while 3.6 billion people, nearly half the global population, interact with at least one Meta app every single day. This chart shows the anomaly causing the panic. While revenue growth remains steady, the red line representing free cash flow has plummeted. In just 1 year, Meta's quarterly cash generation fell from nearly $11 billion to just $784 million. This valuation reflects a structural cash flow crisis triggered by a pivot in spending, rather than a lack of interest in the platforms themselves. That capital didn't just vanish, it was funneled into infrastructure. Meta spent $31 billion on capital expenditures in the second quarter alone. This represents the largest capital allocation bet of Mark Zuckerberg's career. The central question for any investor now is whether this $31 billion spend is building a new trillion-dollar tech epoch, or if it's a project that will simply incinerate cash. To find the answer, we're going to look past the headlines and run the numbers through 3 distinct valuation scenarios to see exactly what the current $592 share price is actually pricing in. Buying the stock today requires trading away the certainty of near-term cash returns for an expensive, unproven AI gamble. To understand the risk, we have to look at the engine funding it. Meta's advertising business recently approached $61 billion in quarterly revenue. That growth is fueled by a dual leverage flywheel. Ad impressions rose 14%, while the average price per ad increased by 12%. With gross margins of 82%, the core business is profitable enough to fund these internal experiments without Meta needing to take on significant debt. However, this high performance in the ad division can mask the reality that one single business unit is carrying the entire financial weight of Zuckerberg's experimental divisions. There are also external pressures. Meta was recently hit with a $567 million penalty in New Mexico following a child safety case. Financially, a sub-$1 billion fine is manageable for a company bringing in $60 billion a quarter. The real danger is structural. Regulators are beginning to target the specific engagement mechanics like infinite scroll and autoplay algorithms that keep users on the platform. Forced changes to these app mechanics would directly shrink user watch time, suffocating the ad inventory that pays for everything else. Even without regulation, the spending is a headwind. Capital expenditure leaped from $17 billion to $31 billion in just 12 months. This chart shows how Meta spending compares to peers. Its CAPEX to sales ratio sits near 60%. Nearly double Amazon, and significantly higher than Microsoft or Google. This spending drives R&D to 36% of revenue, squeezing free cash flow margins from 30% down to 18%. Compounding this is Zuckerberg's own admission that internal AI timelines haven't accelerated as expected, leaving the date for a return on this investment uncertain. Meta is successfully building a world-class computing moat, but they are asking investors to endure a cash squeeze with no guaranteed payoff date. We can map these risks using 3 scenarios branching from the current $592 share price. In the bear case, we assume infrastructure spending stays elevated and AI fails to generate returns. This keeps cash flow compressed, putting fair value at $501. Under those assumptions, the stock is 15% overvalued today. The bull case assumes Meta successfully monetizes AI through subscriptions and enterprise compute sales, driving cash flow over $100 billion by 2029 and a valuation above $1,040. The $500 gap between these outcomes shows that Meta's value is now entirely a question of AI execution. Our base case lands at $734. It assumes AI doesn't need to be a standalone business to justify the cost. If the investment makes the existing ad machine slightly more efficient, it allows a return to historical cash flow levels as spending growth slows. At current prices, Meta trades around 18.6 times forward earnings, a discount compared to its 5-year average of 22 times. That discount indicates the market has already factored in the near-term friction of this spending cycle. At $592, the market is pricing in a mild version of the base case. For investors willing to wait through a few years of compressed cash flow, Meta offers a 19% margin of safety for this dominant advertising monopoly.